Thank you very much. And thank you to Bambina and also to Rick for hosting today's session. It's a real honor to be invited to speak to you all. Listen, the theme of this the session today is looking beyond the pandemic and how the world will look, at least from a real estate perspective, after the virus has been beaten. But I just first want to touch on the pandemic itself, because ultimately our timing comes down to that process of defeating the virus. There is the reality that the virus isn't yet beaten. There is a glimmer of hope. I noted that the numbers of cases globally hit an all-time high on the 27th of April, and from there, there's been a slight decline over the past few days. The vaccine rollout has surprised on the upside in terms of the effectiveness of the various vaccines which are being used globally, delivering more than we probably hoped for even a year ago. The challenge ultimately comes down to delivery and production of the vaccines, and most economists are looking at 2022, 2023 as the best estimate for when global vaccination will either be completed or at least largely complete. So at a global level, the themes that we're talking about today will be impacting some markets now and certainly over the next few months. So places like the UK and the US, slightly later in Europe, and then rolling out into Asia and elsewhere from there. We've already got the benefit of lessons from those countries which either locked down and managed the virus very well, or that they've had very strong vaccination programs like Israel, etc. So there are lessons that we can take from the global property market to help us understand where things may be moving. As Rick said at the outset, I'm going to discuss the global property market through the lens of the Knight Frank Wealth Report. Now, this was published back in March. And for the last 15 years, the report has assessed the impact of private capital on property market performance. And the reason for doing this is because what we've been analysing over the past 15 years is how closely private wealth has become critical to the performance of commercial and also obviously residential markets at a global level. Nearly a third of all global property investment is now driven by wealthy or affluent individuals, either direct purchases or through their companies. So an understanding of the behaviors and the attitudes of the wealthy is fundamental to an understanding of global property market trends. So over the next 10 minutes, I'm going to discuss the future of global property markets. I'm going to focus on 5 key themes from this year's report. And beyond the headlines that I'm going to share with you, there's a huge amount of data and information and insight in the report that you can delve into and investigate market opportunities in more detail. So I'll move on to my first theme, if I can, on my slide deck. Let's think about the global policy response to the pandemic. And it's rather similar to the story after the global financial crisis, in that we've had lower interest rates, more fiscal stimulus, and it means that asset prices have surged around the world. In fact, our wealth sizing model inside the wealth report confirms that the world's ultra high net worth population rose by about 2.4% last year to more than 520,000 individuals. And that process was seen in most parts of the world, across North America and Europe. But it was Asia, with 12% growth in a single year, that saw the real upswing. And this is one of the key narratives that we explore in the report, that the US is, without doubt, the world's dominant wealth hub. But over our forecast period, Asia is likely to see the fastest growth in ultra high net worth populations, well above the global average. And actually, by 2025, Asia will host nearly a quarter of all ultra high net worth individuals, up from 17% only a decade ago. And the region's already home to more billionaires than any other. A second theme we touch on is how actually that growth in wealth through the pandemic actually provides a risk to future wealth creation. So nearly half of our attitude survey respondents in this year's report confirmed that the growth in wealth inequality is expected to lead to demands or increased demands for policies aimed at curbing that imbalance. So over the past 6 months, We've seen new or proposed plans in places like Argentina, Canada, South Korea for wealth taxes, and it's a key part of the tax discussion in the US under the Biden administration as well. Moving on to my second theme, how has the pandemic impacted on cities? Urban centres, particularly in locations like Europe and the US, appeared to be a major casualty from the pandemic. So wealthy residents were reported to be leaving cities. Central business districts have stood empty, and retailers have stared into the abyss as many of their markets have been locked down. But against this backdrop, we've taken a deliberately positive view of cities. There's no doubt that the wealthy have been favouring, certainly in Western economies, country property or suburban property over city property. But there's also a counterpoint here. Our data for London shows that we've hit a record high in the numbers of people, so London-based buyers who are not sellers, i.e. the surge for, say, suburban or country homes reflects a growth in housing consumption. There's likely to be more second homeowners in affluent markets at the end of the pandemic than at the beginning of the pandemic. And I'll see in a moment actually how changes to working patterns and the use of the office opens the opportunity for redevelopment and regeneration. And one of our key findings really from the report is that the pandemic, far from undermining the city, has shown the potential for rebirth. And it's striking that when we asked in our attitude survey which property sectors were most in demand amongst wealthy investors, development opportunities moved into third place, showing that wealthy investors are increasingly attracted to the opportunity to be involved in remodeling and reshaping cities after the pandemic. So on to my third theme, prime residential property. It's a cornerstone of the report. Kate Everett-Allen, our head of international research, who edits this section of the report, she confirms that house prices rose through the pandemic because of the pandemic, not despite it. So a combination of themes, low mortgage rates, a search for space and changing commuting patterns all help to push prices higher. In addition, the pandemic-induced boom that we saw is likely to continue this year. Our attitude survey reveals that 26% of global ultra-high net worth individuals are planning to buy a new home in 2021. And it's worth considering this issue in more detail. For example, in the US, prices of houses have increased by 11% over the past year. It's the strongest growth in 15 years. In New Zealand, prices are up 22%, and average global prices are up by their fastest rate in a decade. Now, why is this the case? Well, house prices have been boosted by low interest rates, by fiscal stimulus, as I mentioned, but you've also had high savings rates in many economies. Saving rates have increased by 50% during the pandemic, leading to increased deposit funds. Borrowing costs have also rarely been cheaper than they are at the current time. And you've also seen that shift in demand away from big cities towards housing in less crowded environments. The response to this is that governments are looking to control what they see as exuberance in the marketplace. So in New Zealand, you're already seeing moves to include housing prices and house values in the calculation of central bank policy decisions. And in a growing number of locations globally, including Spain, looking at a rental control policy as a way to mitigate the impact of rising property values. Against this, actually, the fact that in many locations, the reality is that mortgage debt and mortgage payment costs are actually at historically low levels, and bank positions are actually stronger than they were during the last financial crisis. One of the key issues that we see, and we've mentioned in our report, is actually the need for governments to increase opportunities for house building and also for allowing access to people and also in terms of co-living accommodation. On to my fourth topic. The pandemic has disrupted commercial real estate in a significant way at a global level. And this is an area we focus at in real detail in this year's report, despite the fact that overall property investment volumes fell last year, unsurprisingly. the capital deployed by private investors was still 9% above the 10-year average, far stronger than the 6% fall that we saw from institutional investors. And that trend is set to continue through 2021, with a quarter of ultra high net worth individuals planning to invest this year. And a key area of focus in the Wealth Report is how the pandemic is driving real estate innovation. So we've tracked where private wealth has been invested, but we've also assessed how the COVID crisis has accelerated market trends, opening new opportunities. One of the key areas, obviously, is the office market. Office demand is likely to decline in the near term, but probably less than initially expected. A recent European study suggested only 17% of chief executives expect to cut office space in the next 3 years, down from nearly 70% in the same survey 6 months earlier. So there's been a huge shift in the attitudes of office occupiers as to how they will be using space in the long run. And actually more companies are thinking about work from home as a potential opportunity to attract employees. But in reality, even this particular story is shifting right now. JP Morgan commented that 10% of their global employee base may work from home full time, but the vast majority will be expected to be coming back into the office. And there'll be many more announcements recently. Rents in the office market will be under pressure. There's no doubt that there is a significant issue at the moment around releasing of space, but we see increasingly in many developed markets a divide in the marketplace is occurring. High quality, the best quality office space, which aligns with future working habits, is very much in short supply. And at the same time, there is a significant lack of supply of green or BREEAM excellent buildings, the types of buildings that are in demand by office occupiers and corporates right now as they try to fulfill their ESG obligations. But rents are likely to decline, in some cases quite significantly, in older, poorer quality workspaces. But these themselves offer opportunities for redevelopment and for regeneration. There are other spin-offs from this. The range of places to work will widen, or is increasingly set to widen. It may be that actually there will be that divide between working from home and working from the office, but there will also be a demand for alternatives. And one of the areas that the industry is looking at is hospitality. But actually the hospitality sector, particularly hotels, are ideally well placed to provide that alternative third location between working from home and working from the office, and something which we expect to see develop over the next few years. Just thinking about other sectors, the retail sector has seen significant disruption through the pandemic. Retail stores have found themselves to be at a fundamental disadvantage, obviously, to online during lockdowns, but also in terms of the acceleration of an existing trend. Retail stores not only suffer compared to online in terms of pricing and delivery, but the scale of choice that websites can offer is vastly greater than that's offered by retail space. And actually the shift in rents in developed markets, that we've seen rent falls of say 10, 20% in some locations, and even up to 30% in some markets, are again entirely explicable when we think about the impact of lockdowns and of COVID. However, again, set against that, it isn't a single line narrative. That mix of online and in-store sales is something which is beginning to prove to be a winning model. And for example, Amazon itself could eventually have over 4,000 stores globally. We're seeing more of a rollout of concepts from Amazon right now. And what's driving Amazon's move into retail, into physical retail stores, is actually a cost-effective way of delivering the three most important things that retail does. Firstly, acquiring customers. Secondly, getting goods to customers. And then thirdly, building brand awareness. The problem, of course, is that we'll need many more Amazons to actually stabilize demand in the retail space and also occupancy. In terms of logistics, even a market as mature as, say, the UK logistics market has got room to grow. And the expectation is over the next 4 years, there'll be a growth in online retail in the UK and European markets of well over 25%, possibly up to 50% in some Southern European markets. And the same story has been played out globally. Despite a huge building boom of logistics space over the past decade, and we've seen a record amount of warehouse space built at a global level, the demand is only increasing, and rents are expected to increase significantly over the next 5 years as demand for online shopping and online delivery continues apace. My final theme I will just touch on briefly is luxury investments. So the image on your screen comes from the photographer that we use in this year's report, who is selling his photographs from galleries across the UK, Europe, and the US, and increasingly from Asia as well, finding a ready demand from investors looking for unique assets. So a key component of the wealth report is our ability to take a wide view of the wealth portfolio. So over recent years, we've developed our Knight Frank Luxury Investment Index, and that tracks not only the performance of luxury collectibles, but it also confirms how the search for returns in a low inflationary world has led to a growing demand for asset classes at a global level. And we see in this year's report how this search for returns is driving one-off sales. And for example, we report on the sale of a T-Rex skeleton to a collector in October of last year in New York at a record-breaking price of $32 million, alongside some other significant one-off sales, but again, showing the demand from investors to try to benefit from diversification and searching for returns in a low inflationary environment. Across the whole of the luxury assets that we cover, collectible handbags, surprise on the upside, up 17%, but actually a sector of the market which pioneered online auctions, helping liquidity even during lockdowns. Other sectors to see strong performance was fine wine, classic cars, but as physical auctions were put on hold, the art market itself saw values fall by about 11% over the course of the past 12 months. It's a whistle-stop tour of the content of the report, but hopefully gives you some ideas for the question session. In summary, we've seen a growth in wealth through the pandemic, really in response to government policy measures, a growth in asset prices due to falls in interest rates and continued stimulus measures, an expansion in demand for luxury housing at a global level, a polarizing office market at the current time, a rapid retail evolution with opportunities in best in class, but also a strong opportunity there for logistics and other emerging sectors that I haven't had a chance to touch on. That's it from me. I'm going to pass you back to Rick for his presentation. Thank you.
In terms of COVID, the Philippines has been hard hit. There's no doubt about that. We are in a lockdown. We've had a couple of different waves. As you can see, the top line there is the U.S., followed by India and Brazil. So Philippines has been less hard hit than places like India, but it has breached over 1 million cases just last week. So within distress, there clearly will be opportunities. Winding back the clock back to 1997, you know, the 1997, which was really the last major financial crisis, real estate crisis we've had of significant, which saw, you know, deflation, asset prices, et cetera, gave birth really to the whole BPO sector, with the currency being cut in half, and it made the labor arbitrage element. So there will be some upsides as well, which we'll go over. Next slide. In terms of the economic overview, we were about a negative 14% last year. This year, we're looking at, according to the World Bank, about 5.5%. Philippine government's looking to as high as 7.5%, and the ADB's about 4.5%. And with 2022 looking even rosier, and also that will be a presidential election year as well. So look for some surge over that. So look for about 6.5% next year. According to the World Bank, ADB is looking at conservative 5.5%, and the Philippine government we're at 6.5% and 7%. So there will be growth, and clearly we'll talk a little bit about why. Next slide. Overseas remittances, obviously a huge driver. BPO is a big driver. Remittances is a big driver. If you can link your business to the BPO sector, if you link it to remittances, you probably had a winning business. Despite last year being hit extremely hard, remittances were only down about 0.8%, and they're looking for a 7% uptick this next year. So that will be a big driver for the economy as well. Next slide. The other big driver, which really conquers all, it's really the demographics. It's really the sweet spot of the countries. When we say demographics, we're talking about people, the age of people in the workforce. So the slides here show India and the Philippines have very similar demographics. If you look at Japan on the far left or South Korea, it's an aging population, similar to Europe or the US. So India, the Philippines, and Vietnam do have that secret sauce of young people in the workforce, willing to work hard, smart, educated, et cetera. But they're also in that sweet spot. So and they're also in the sector where they're less susceptible to basically the very negative effects of fatalities related to COVID. So that's positive. Also, with certain industries being hit, it's no surprise. Tourism, hotels is getting hit extremely hard. Travel extremely hard. So you're seeing a lot more of these workers becoming available in the call center BPO market. That market as well been very difficult to hire people, et cetera. Also seen a lot of overseas foreign workers come back. So we're going to look for a very plentiful labor market once there is a rebound. And there will be a rebound, and there is light at the end of the tunnel. Infrastructure. So this government actually has done a good job getting infrastructure built. I mean, some of it's a hangover from other governments, but actually the pandemic has allowed construction to happen quicker, whether it's on Tiplex or Skyway Phase 3, the Rockwell Bridge, Calax, Santa Monica Lawton Bridge. So with no traffic and people being locked down, these construction projects have continued on. So this has opened up a lot more opportunities in the real estate sector. And in terms of the ability to get to some of these major residential developments, it's really cut that time in half. Next slide. In terms of the real estate overview, 2021 is looking extremely positive for the industrial, logistics, and urban residential REITs. In terms of flexible office setups and workplace mobility, that's also another area of significant growth. In terms of this is really the year of the tenant. I say that the ability for tenants to renegotiate rates, et cetera, in terms of tenants to renegotiate rents, innovatively structure deals, et cetera. So we're looking at deal structures that look at things like contribution towards tenant improvements, rationalizations of office space, new workplace solutions, developers also repositioning some of their offices into retail space, and also putting a lot of these assets under the REIT sector. So it shifted really very much from a landlord's market to a tenant's market. In 2021, the work from home also has really taken off. And people talk about the ability to understand commercial real estate, commercial office real estate. The only way to understand office space in this market today is you need to understand the residential market. And by understanding the residential market, as Liam talked about, everybody's experienced some work from home this year. So in terms of understanding that, you might reduce office space, you might rationalize it, you might sublease space, but everybody now needs to understand the balance between time in the office versus time at home. And the tenants market should include new incentives. There's a plethora of options that have come out with creative restructuring, creative financing, repurposing of offices. REITs have been a significant factor because a lot of developers now, they're having a hard time getting profit out of their business. So they're moving towards looking to shore up their balance sheets, looking to recycle capital. So these are all things that have made this market very dynamic and excellent for negotiating as a tenant. Next slide, please. In terms of residential, this is the slide with regards to, it looks at how much do you get for $1 million? In Monaco, you would get 15 square meters. In Manila, you get 314. In Shanghai, you get 50. So this shows how far you can stretch the peso and how far in terms of prime residential, how far that dollar goes. This is a Knight Frank global survey. So this does show that in terms of Manila, that's why high-end residential, especially on the office side, has really held its value. This slide should be particularly useful to a lot of our viewers watching with regards to what's happened if you live in Forbes Park, Dos Marinas, Urdaneta Village, Bel Air, San Lorenzo, Magallanes Village, etc., Ayala Alabang. These have all been some of the prime residential villages. We have seen distress in certain sectors. We have not seen distress on the high-end residential housing sector in the house and lot size sector. Forbes Park now is trading about 450,000 pesos per square meter or more. Over the years, you've seen capital appreciation then just since 2014, about 125%. So about 12% per annum. So following similar numbers in Dos Marinas, Urdaneta, Bel Air, San Lorenzo, Magallanes, also Ayala Alabang. Ayala Alabang here is a relative bargain comparison to Makati, et cetera. And also what Leon talked about in terms of trends, there is a trend for people to want to move outside the city. Decentralization, et cetera. There's decentralization, there's centralization, but also what we need to think about is, what was the Philippines like pre-COVID? Do we want it to go back to that pre-COVID normal, or do we want to create a new, better normal? There's always been a huge push to decentralize and decongest the cities. So this is a great opportunity for actually the Philippines to do that. Core CBD properties will always do well on the luxury residential side. You've seen some pressure on the condominium side, but luxury high-end in the villages, it's unique. And if we would have done this chart over back 20 years, you would have seen probably a 20% increase if you factor those in. So luxury residential in the villages tends to definitely basically be a great long-term nest egg investment. What happens when you shut down the airlines? You can't fly, et cetera. You go buy out in Batangas, you go out in Punta Fuego or whatnot. You see more people down in Nuvali, Tagaytay, people going up to Baguio, Antipolo, new areas that, even myself, I mean, I fly, a million miles every 2-3 years. I hadn't been a plane for 14, 15 months. So what do people do? Where can you get property within half an hour and 2 hours drive? And Batangas has been great for vast space, greenery, rustic charm. Antipolo, winds, quiet. Nuvali, Tagaytay, great views, etc. Baguio, I mean, to get up to Baguio with the new infrastructure we talked about, provided it's cut the time in half. If you, La Union used to take 10 hours, now it takes 4. So it's given rise to a whole new beach community as well. So look for some great opportunities also in the distressed sector outside of town. If you're on an island property, you're getting hammered because you basically had no revenue as a hotel resort owner on some of these islands, maybe in a year, and it might be 2 years. So there'll be some real premium opportunities for developers in some of these pocket areas, driving distance of Metro Manila, and some real distress opportunities in the islands. Some, Liam talked a little bit about some of the global phenomena. So industrial logistics, it's a defensive sector globally. So retail is loss, shops pain is industrial logistics gain. So this sector is definitely a winner. And it's been driven by a lot of different reasons. We'll go into those, but we're also looking at repurposing. So commercial and retail converted into storage. And, not just post-pandemic, but pre-pandemic, we saw cold storage boom. And it'll now be even ever present as we bring in more of the vaccines in. So industrial logistics, that's really an easy win with some huge opportunities there. Look for other niche opportunities like self-storage as well to come out there, distribution centers, dry storage, et cetera, on specific cold storage for the vaccines. Okay, real estate investment trust. We lobbied really hard. We helped get the legislation passed in 2007. It took us until up about in terms of getting the implementing rules and regulations. Didn't really get it done until about 24 months ago. That's gone through. The ILA REITs, the A REITs gone through. Slow start, picked up, did extremely well. There's about 5 other developers in the pipelines looking to follow suit. Double Dragons come out of the box, probably a similar to slow out of the box, but look to creep upwards. Look for a lot of expansion in this sector. Mainly, I think initially people looked at listing a lot of their retail assets. Now they focused on the office. So look for a lot more real estate investment trusts to help move the market. And also this will bring in a lot more overseas capital. And REITs are all about paying out 90% of their earnings to shareholders. So Joe Sixpack, the man in the street, can earn alongside the big guy. So pretty good investment across Southeast Asia. And look for this to be a great way to generate liquidity and also to see more velocity in the sales market. So across the sectors, in terms of best to worst, the industrial sector, very stable for demand, slam dunk, easy opportunity. Obviously, look at price inflation, still huge opportunities for investment. The residential, high-end villages stayed stable. Resort properties within 2 hours distance of the Metro Manila, with good amenities has boomed. Condos have gone under pressure. Lease rates have dropped. Capital values have dropped. So some opportunities to pick up maybe some distressed residential from individual owners. Office sector, I think it's gotten hit hard, similar to most of the markets. Work from home, as we've seen, does not work very well. Why doesn't it work very well? Because of multi-generational households. It's a blessing in disguise. The internet connections aren't very good, so people need to get into the office. And the bulk of our workforce is young. Very difficult to train a workforce if they've never met face-to-face with their mentors and colleagues. So we found that secret sauce is getting the young folks back into the office. So, and hub and spoke will have an opportunity to come in. Maybe it will be, staggered workforce, staggered teams, et cetera. But these are all opportunities for the office sector. So will be some niche opportunities in there as vacancy rates have gone up and lease rates have, and you've got a record supply coming on as well, and lease rates have come down. POGOs aren't coming back. These Philippine overseas, a lot of the mainland Chinese overseas game companies. So office sector will be opportunities there. The hardest hit retail and hotels and resorts. I like those sectors as a distress play. Retail has got to reinvent itself globally here. People like to mall. They like to go. Malling's the sport here. They like the aircon. They like to go in there. There will be opportunities in repositioning retail into residential, into office, into storage, et cetera. And hotel and resorts, especially the island resorts, absolutely hammered. So that will be the biggest drops, most distress, and hence biggest opportunities for equity or debt players as well. And also the specialist classes such as data centers will come up the chain as well. Yeah, just going back to the that office slide as well. In terms of that office sector, we will see eventually that office will come back. I think within the scenario that we're seeing now is Leon talked about his themes. We're seeing a couple of themes as well. One is in 2020, CPR. We talked about what does it take to survive in a double black swan, which probably a triple black swan event. It's cash. Without cash, you can't. Without oxygen, your business doesn't survive. People don't survive. So you need to pivot and pivot quickly, and you need to be resilient. That was the theme for 2020. That remains. But in 2021, we move into the R's, which is, since you've been able to preserve cash, hang on your business, pivot and be resilient, great opportunity to reimagine things, create land bank, look for distressed opportunities, reposition what you're focused on. Maybe you were a niche retail player. Maybe you're going to go to industrial logistics now, but great opportunity to also build your land bank and reposition. We're seeing a reinvention all over the place. Certain sectors, if you're a hotel developer, you're probably changing. You're going into maybe a niche residential play, or you're moving into the industrial logistics. So flexibility is going to be key. The one man's loss is clearly another man's gain. So this is the best opportunity that we've seen since the Asian financial crisis, 1997, which hit 1998-99, and we had a lot of the asset management SPVs set up. So the problem with a lot of these crises, you look at the U.S. markets, I'm sure Europe's the same, is they don't get distressed enough. You don't see prices come off too much. In the US or the UK, you'll have stimulus package, you'll have bailouts that will inject money into the economy. So that is a problem for real estate investors, distressed debt buyers, because the market isn't affected, and it's probably falsely propped up. Philippines and a lot of the Southeast Asian markets or Thailand don't have that problem because the government doesn't have the ability to inject the funds, and there isn't going to be a safety net. So either the banks will extend and pretend loans, or they'll call their loans, or people will distress or basically sell off non-core assets to basically protect their main business. So this is a huge opportunity in the Philippines that we haven't seen really since 1997. We saw a little bit of a blip post-SARS when Hong Kong, that was a good time to buy, post-SARS in 2003. 2007, global financial crisis, didn't really affect the Philippines too much. Other areas of opportunity is sources of capitalization. There was enough local money and local capital to get most deals done. Now this market will need to go out, and they've gone out to the REIT markets, the major players, the Taipans. There's not one big family, one big Taipan organization. One of their businesses hasn't been hit, whatnot. So, and they will come back. They will be able to raise capital. You've seen some of the airlines here raise capital, whatnot. So, but this is also a great opportunity for select opportunities in overseas equity and also debt funds. So this market will now need foreign capital. So we see these as some great opportunities in the market. And in terms of other trends, the work from home, I think that will need to be addressed. I think, we talk about second, third, fourth, fifth wave, et cetera, of COVID coming in. I think we do have the vaccine coming in, but hey, waves are coming in. So, don't get crushed by the waves. Waves comes in, and, get your surfboard and take care of those opportunities. Philippines also, people looking at India now saying, well, India is getting hit extremely hard. Philippines is getting hit hard also, but India as well. So people say, well, listen, it isn't India or the Philippines, the BPO. It's got to be India and the Philippines. And do we put more emphasis in that BPO sector in the Philippines, et cetera? So people are taking a look there. The demographics are crucial. So the Philippines will bounce back. If you look at some of the service markets, even in retail, now that restaurants and shops are reopening, they don't have enough workers. So, and also some of the workers they used to bring cross-border, because of visa issues, you don't have foreign help to come in and cross-border help. So that's a big issue as well. Infrastructure advances are out there. So, and also centralization, decentralization. As Leon talked about, we need to reinvent the cities so they're not a ghost town at night. So let's build more residential. And let's have those people stay downtown. Let's not have everybody commute from decentralized areas. So let's decongest those cities as well, so we get hub and spoke mechanisms outside. So these are global universal themes, but huge pain, but huge opportunities. But don't let this downturn, never let a good crisis go to waste, right? So once there is maximum pessimism, and we're probably getting pretty close there in the market as we've seen the lockdowns extend, that means maximum opportunity, and maximum opportunities will bound. Thank you very much. I'll hand it back over to you.
All right, I think everyone's on the screen now. Well, an exciting time. Let's kick it off with a few questions. I'd like to go round robin in this particular question. So I'll call each person as your turn to answer this particular question. So the question goes like this. There's been a lot of discussion about long live the city. Some people believe that they no longer need to be within close proximity of cities. And there are also discussions on making cities more livable and sustainable. In your opinion, what will be the future of cities and urbanization post-pandemic? What will livable cities look like post-pandemic? I guess with this question, we can start off with Carson.
Yep, thanks. Well, first and foremost, I think we need to say that cities are for the people. And this is clearly something we've realized during the lockdown, when some cities were turned into sleeping giants, especially the business districts. So when you have parts of the city where no people live, then this is clearly detrimental for the city overall. And we've already heard before that there are developments going into the direction of to reshape and redefine the city. So livability, of course, is something which relates to many factors: housing, safety, accessibility to basic services such as electricity, water, leisure, culture, all these things. And of course, they play different roles in different cities in the world. So you need to consider these kind of special factors when you make up your mind what livable is. Sustainability relates, in my view, very much to the city's resource use and their overall footprint. And again, here, I mean, not all cities are created equal, but generally, we are under the impression that technology trends are transforming the cities in the sense that they are not becoming smarter. I mean, there's this buzzword of smart cities, which we hear quite a few times. But the smartness can be used to make the cities more sustainable in the sense that water and waste management is being done in a more efficient way, that traffic is routed in a more efficient way, and that in the very long run, we actually remove some cars from the streets because we are using autonomously driving cars, at least in the world cities. So these are some of the aspects we look at when we think about livable and sustainable cities, because at the end of the day, those two go hand in hand. If cities are safer, if they are cleaner, if they are calmer, they are more sustainable, but they are also more livable.
Thanks for that, Carson. I think we can ask the same question to Liam. What are your thoughts on this?
Thank you very much. I think that the first point I'd make is that cities will thrive. I mean, primarily because there's no option. I mean, we've documented that, lots of affluent people have left places like New York or London, and they've been looking at the suburbs and beyond as alternative locations for their families through the pandemic. I think our conclusion is probably these are plans that would have happened in the next one to 3 years, but they were brought forward by the pandemic. So kind of decision making was kind of accelerated. But the reality is for everybody else, for the vast majority of the population, you don't have that option. And actually, not everyone wants to have a very long commute, and not actually everyone works in an office where they can potentially work from home. So I don't think there's a really big option here. The other thing, actually, just touching on what Carson said, is cities are the sustainable option. Actually, if everyone was to move remote and live in the middle of nowhere, actually it would be unbelievably unsustainable. So actually, in terms of government policy and government requirements, making cities work is a really necessary thing to happen. I think there's lots of positives. Rick touched on it in terms of mixed use, making CBDs more livable and all those kind of things. I think that's really good, and it's definitely happening in many locations. The one area that I think there is a real opportunity for investors, entrepreneurs, etc., is around skills. So actually the ability to develop really good quality mixed use sustainable development is quite a rare skill set. I see it done well in a few places. I see it done badly in lots of locations. And I think actually one of the biggest challenges we have in the West, but also globally, is actually this kind of change of use of some office space, not all of it, but some office space, retail space being changed into residential, into logistics, etc. There are some big challenges coming, some big opportunities, but actually to do it well requires a really kind of deep relationship between the public and the private sector. And those cities that kind of get that balance right, I think, will do very well. And if you get it wrong, I think the outcome could be quite negative.
Yeah, so it's like we keep the cities, but we have that level of refurbishment or repurposing or rejuvenation of some areas to make it more sustainable and livable.
Yeah.
All right. Rick, the same question regarding livable cities.
Yeah, I agree with Carson and Liam. I think the city is got to come back. I think in the Philippines, you're going to see eventually, as the vaccine gets rolled out, BPOs will continue to move their staff from homes back into the office. Call centers will continue to expand. I think you'll probably see more labor shortages actually in places like the US and Europe. So more outsourcing activity coming out our way just because people can't cross borders. I think also with cities will come back. I think it will. I mean, people will want to be outside, right? I think you're seeing that now as good weather approaches and people want to get outside. They want to breathe, so sustainable cities, it used to be a nice to have, people always talk about, being, having, inclusivity and sustainability and ESG and safety. But now I think they actually really mean it and have to live by it. So if you're going to cities of the future, really going, or even the Philippines, you've got bike lanes, you've got green space, you've got breathable space. So I think it actually could be quite a positive trend. I don't think we want it to go back to, chock-a-block traffic where, you're stuck on EDSA for hours and hours. So I think a lot of people now will continue to work and be in the office, but you'll see more decentralization. You'll see more centralization of people that want to be in the urban core and don't want to go on those commutes. You'll see people that won't want to sit in traffic for 2 hours and either stay in the area where they work. Also, education is going to be key as well. If you look at the main drivers, why is Silicon Valley successful? Because it's got the Berkeleys and the Stanfords and the Santa Clara. There's got the good skill sets in the venture capital areas. So a lot of it will be around education as well. A lot of educational institutions have really struggled if they haven't been able to go online. So I think this online, offline, complementary setup is going to be key. So I think offices will return. I think they'll return in a different manner, and they'll also be able to embrace the technology that's whether it's Zoom calls or MS Team calls. So I think you'll have a much more actually efficient workforce and probably a little bit more balanced workforce once we come back into the offices. But cities will definitely return, and hopefully in the Philippines it will return on a little more humane basis, a little bit more decentralized basis, and a basis where it's much more sustainable and green. And I think also occupiers will demand that, and also investors will demand that.
Thanks, Rick. Before we proceed, I'd like to take this time for the audience to look at your screens. There will be a poll question for you to answer. So just there is a question there. We'd love your feedback on it. I think we can now proceed to the next question as the others, or as the audience answers that poll. Okay, so what are the real estate opportunities you see in 2021 and post-pandemic? Which real estate asset classes will thrive? What is your outlook for specialist sectors? We know that some sectors are doing quite well, but we'd like to know your thoughts on it, such as data centers, industrial and logistics, co-living and co-working. So I think this question regarding the real estate asset classes that will thrive, I'll throw this off first to Liam.
Thank you, Cash. I think there are lots of opportunity areas. I mean, you mentioned data centers. It's one that's been talked about quite a bit, and actually for a good reason. The London market for data centers is Europe's largest market, and demand rose by 60% in 2020. So you can kind of see the impact of the pandemic on data usage and so on, and understand why it's been such a growth sector. The problem that you have with the data center sector is that it's a relatively niche sector. The size and scale of the sector isn't particularly big, although it is growing rapidly. You've also got the issue that it's quite a technical sector in terms of the costs of setting up and equipping data centers. So actually the access to power, security, air conditioning, etc. It's not an easy product to bring to market, but it's certainly an area that will see growth. I think the other area which is quite interesting at the moment is the sort of institutional residential. So certainly in the UK and in European markets, we've seen a big growth in the student accommodation, and actually, ironically, despite the pandemic, actually UK student accommodation has been quite a strong sector this year in terms of occupancy. But the other areas are things like retirement, so actually sort of purpose-built retirement accommodation. It's relatively embryonic in most European markets. It's quite mature in the US and Canada and Australia, but there is lots of growth potential for some of those sectors as well. I think it's an interesting point that we touched on in a previous wealth report, talking about the evolution, the added value property. So actually, as we see yields squeeze and as we enter a low inflationary, low interest rate environment, the value of service, the ability to add value through branding and service, etc., becomes ever more important to try and improve your yield and your return on investment. And those sectors where you've got kind of managed services around residential property, I think are quite an interesting prospect over the next few years.
That's good to hear. Rick, what do you think? What are the real estate asset classes that will thrive?
Yeah, I think I went over a number of those in my presentation, but I think other things, data centers will come in to the fray, especially in the medium term. That's we're seeing a lot more interest in data centers, which don't require people, and so they're COVID proof. They just need antivirus software. That's all they need. So we'll see the growth in data centers. The whole serviced office concept, I think developers might take that in house and look to do that, some of that themselves. In terms of retail conversions, hotel conversions, you look for people. What do they want to do with their hotels? They want to turn that into medical space, to turn those into hospital rooms, etc. For the short term or medium term. I think you will eventually see a boom in travel as well. Once people have the opportunity to get out, the vaccine's been rolled out, they're healthy, you'll see inbound travelers, you'll see outbound travelers. I think that will come back. I think also big opportunities in this sector is probably to partner with foreign players, foreign institutional capital, equity, foreign institutional debt, real estate investment trusts. Use those mechanisms because you can't just do it with your own cash. Also, I think this is very, very clear as well. We haven't seen this before. Is in order to understand the office market, you need to deeply understand the residential market because now they are deeply entwined. And I agree with Liam. Residential is going to be a very institutional classes, whether it's multifamily, institutional, but residential is also proved as a bellwether. I look at transactions every day, and you see residential transactions in this kind of market. Even though you've seen in condos, you've seen condo prices drop and lease rates drop, you've seen volume increase. And even though houses in the villages have held their value, you've seen a lot more of them trade, even if it's the same value, like maybe never before. Payment terms have changed. So institutional and convergence between institutional office and office institutional, that's crucial. So if somebody just says, hey, listen, we don't do residential, we only do office, then you can tell them you don't understand the market. You really need to understand both. Great to understand all the sectors, but now you really need just to understand the office and residential, because at some point, everybody on the call, everybody in the audience has been forced to work from home.
Those are good insights. But looking at a bigger scale, like in looking at more than real estate, I think I'd like to ask Karsten this question, a follow-up question. Like, how did other asset classes beyond real estate perform in 2020 in your research? And what is your outlook in 2021 and beyond?
Well, actually, looking back at 2020, as strange as it may sound, all risky assets have performed well. Let's say after that spring sell-off we had, and equities were clearly the outperformer, given that many global indices reached new all-time highs. More specifically, if we look back at 2020 from my own perspective as a thematic researcher, it has clearly been the year of thematic investing, because many of these investment themes we have been looking at for years, they really started to fly in 2020. And this is primarily because the COVID crisis accelerated existing structural trends, such as the shift from offline to online. For 2021, we remain constructive overall for risky assets because we think that the economic recovery will continue from that recession we had in the last year. And our optimism is primarily based on the vaccine progress, of course. I mean, we see it in countries which are well vaccinated, that they are opening up, that they are returning to normal. And we see another source of support from fiscal and monetary policy by governments and also central banks. So from our perspective, 2021 is a very favorable backdrop for risky assets overall. And in terms of investment themes, I'd say it's basically the ones we've been highlighting last year as well: future cities, future mobility, cloud computing, artificial intelligence, cybersecurity, and then also, of course, digital health and genomics, because we are still fighting this pandemic.
Wow. Actually, like, sounds very optimistic,
Indeed,
but I mean, like, we're seeing more opportunities even though we're in a pandemic. I get before I go to the next question, I think we'll have another poll question on your screens for the audiences. This is related to some of the second homes that you're looking at, or what are the criteria that you're looking at for your second home? And hoping you could answer, the audience could answer that. Okay, so for our next question, I'd like to ask Rick this, because this was in his presentation earlier, that there was an increasing demand for secondary homes outside Metro Manila. One of the examples was Batangas. Rick, do you think this trend will continue after 2021?
Yes, I think that I think it will continue after 2021. I think a lot of the high net worth individuals will be very leery about getting back on a plane in the short term. Some of them have discovered that they're very happy just instead of. I know a lot of friends, high net worth individuals that anytime they had a chance, they'd hop on a plane to San Francisco or Hong Kong or Tokyo or London or New York, and they would neglect going to doing domestic tourism. So I think a lot of those folks, and some they've had family houses for years on the Batangas coast that they've actually never been to in 10 years. So I think you'll see a lot more of those people staying closer to home and realizing that building on that second home, you've seen prices increase. And I think that will continue. Also with the infrastructure getting much better, it's much quicker to get to some of these destinations, and a lot of them have been under touristed and underdeveloped. So you'll see a lot more activity there. So yeah, I think that will continue. And I think there'll be a lot more domestic travel. And yeah, some people will hop on planes again, et cetera. But I think that sparked another option. And also global travel keeps getting more difficult, and it's not hassle-free. So I think this will be a great shot in the arm for domestic tourism, especially for the high net worth investor.
Got it. Thanks, Rick. I think for this question, I can direct this to Karsten. One of the biggest impacts of the pandemic has been on the ways people work, right? The question is remote work sustainable for organizations? Will we see a return to pre-pandemic work setups after COVID-19?
Well, by now, I'd say we are all aware of the advantages and disadvantages of working from home. So I don't want to go too much into that. But for me, the key point is that, of course, it increases flexibility, especially if you want to manage your family, if you need to manage your family, if you want to avoid long commuting times, for example. But it blurs the boundaries between private life and work life. And this is the key consideration for me when it comes to work from home. So what will the future of work be? Well, as often in life, it will not be black or white. It will be not home or office. The future will be a blend of the two, combining the advantages while minimizing the disadvantages. And by that, I mean that when there are days where you don't have any physical meetings, in my case, when I'm writing reports, when I'm doing research, I can do that very well from home. But when there is client meetings, when there is interaction needed with colleagues, it's much more efficient to be in the office, because you do have these informal conversation as well, right? Meeting somebody at the coffee machine, bumping into somebody on the aisle. This is a clear advantage of being in the office. And I'd go so far to say that the efficiency we've shown while working from home initially during this crisis was largely related to first the urgency, because we realized there was no other option than being productive in the home office. And also the fact that we could build on relationships we had established in the past. But think about setting up a new business, setting up a new team, recruiting people, and doing that all remotely. That is much more difficult than in a personal interaction. And then that's why I believe the future of work will be clearly a blend of the two, which of course has implications for office demand, as we've heard earlier.
Thanks, Carsten. I think I also like to know, the thoughts of Rick. Having a company with more than one, with about 1,400 people. What is your experience with remote work, and do you also think that it's sustainable for organizations?
Yeah, I think I think there's a place for work from home. It kind of depends what type of business you're in. I mean, I think if you're a software development company, or you have some brilliant software developer, you can probably work from anywhere. I think the human element is key, and I think the human element, especially in a service business, is really that secret sauce. So what you found is just with, many of us have kids on the phone. I think this whole online school, it just doesn't work very well, right? So if your kids can't do it, they haven't met the professors or their teachers. Yeah, I mean, even if you have the best online systems, you still miss that human interaction. I think, going through a couple different iterations of work from home is where everybody had to work from home, and then we had a skeletal workforce, and we brought people back in. You didn't realize how much you were missing in terms of those conversations and whatnot. So, and also to start a new company be very difficult. New companies, new teams. So it takes years to build up that trust and via human interaction. Also, from a investment standpoint, I mean, a lot of deals, I mean, big ones are just saying, hey, listen, we're not going to spend hundreds of millions of dollars investing if we've never seen the property up close, if we haven't met the management team that's been running it up close. We're not going to fund this developer if we hadn't sat across the table and done our due diligence in person. So that's really slowed things down. I think if you've done deals in the past, repeat deals, recapitalization deals, re-upping, but I think new deals, fresh deals, whether it's real estate, corporate M&A, et cetera, people want to have that interaction face to face. And that same experience, we've had that within the company as well. We've had to do it, and we've been good at it because we have to do it. But I think at the end of the day, we're not robots, we're human beings, and that's our ability to reason, interact. And I think also the psychological toll is also is starting to show as well. Some people really miss that human interaction. They're isolated at home. They're in a condo, so it's almost like putting somebody in solitary confinement. So, and you can only stay in solitary confinement for about 40 days before stuff really starts going wrong. So, yeah, let's get everybody back in the office.
Thanks for that, Rick. I also saw earlier in the presentation, there's this graph wherein, how much $1 million could buy when it comes to residential luxury projects. I think this is a question that we'd like to ask everyone, is that if you were to have $100 million to invest today, where would you put your money? I think we'd like to start off with Liam.
Thank you very much. There's so many things I could talk about. Some of those specialist sectors that we touched on, like data centers and so forth, and urban logistics, the areas where there's real growth right now. I think if I was being maybe sound a bit boring, but I think the potential for repurposing secondary office space is really significant. Not just conversion to other uses or conversion to residential, but actually in the majority of cases, I can think of areas in central London and in Manhattan where there are good buildings that really need repurposing and redesigning, and actually the ability to either redevelop or up-spec property to meet green requirements, to meet the requirements of modern occupiers is significant. And actually, an intelligent refurbishment of an office building can add significant value, particularly as companies start looking to their HQs to do more and add more value to their employees and their productivity. The other area that I would touch on, and you'd probably say, well, I would anyway, but is London prime residential property. It's a sector that saw 25% price falls over the past 5 or 6 years, and actually it's coming. Demand right now is incredibly strong, but it's coming out of the pandemic in a very sort of healthy position. So I think there's scope in the prime markets in London, and I think also in some of that secondary office space.
Liam, I think we could ask the same question to Karsten. Where would you put your $100 billion?
Well, if I had $100 million, of course, I would consider the services of a specialized wealth manager in order to structure my assets as efficiently as possible, right? I mean, that's clear. When it comes to investing, I think what is most important, especially in the equity market, is to diversify, right? To diversify within asset classes and to also diversify across asset classes, equities, bonds, real estate, just to name the most important ones. And equally important is to stay invested and not try to time the market. I guess we've all tried that, right? I would say, but most of us have not been very successful in doing that, right? Just last March last year, everybody would have sold into the down market, and most likely people would not have come back because they feared this pandemic too much. So this is a key statement we send to our clients, and we also take for ourselves, stay invested. Clearly, on the equity side, I do have a preference for my themes, the themes I'm looking at, because they are so tangible. They are related to how our world changes. I'll take future mobility. We think that by the middle of the century, 80 to 90% of all cars sold will be electric. So this is a huge opportunity. Take future cities with what we've heard before, but also with the expansion of the classical infrastructure, digital infrastructure, building technology. These things are going to shape our cities in the years to come. Take what I said before, genomics and digital health. We've just seen how unprepared some of our healthcare systems are for such a pandemic. And we do have the tools to make these systems more efficient, to make them more resilient, right? So this is another key area for me. And then with all these shifts from offline to online, I think there is no way around cloud computing, artificial intelligence, and unfortunately also cybersecurity, because the more we put online, the more we are running the risk of being attacked. So these are clear secular growth themes from our side, which we would put our money into.
That's good to know, Karsten. Rick, how about you? Where would you put your 100 million?
Yeah. The real estate market, slightly different than the equities market it's really a deal by deal approach. I mean, you go across the asset classes. The difference about this market now is it's anticipating the timing. And in this market, you do want to anticipate the timing because you're going to have significant opportunities from key people across different sectors. So I would go sector by sector and say, listen, I mean, if you can time the investment into the hotel and leisure sector, and you can actually get good pricing and you have the staying power to hang on, you're going to do extremely well. The same thing across, the office sector, that will come back. The industrial logistics sector, we know that's a winner. So, but the issue is trying to find a deal that makes a lot of sense. So I think the thing here now is, and in the real estate business, you don't need to buy the market. You don't need to buy the index. You just need to find those individual opportunities on a deal by deal basis. You need to find one distressed individual, one team that's undercapitalized, and those come from proprietary deals. So you can find opportunities, whether it's office, residential, industrial, retail, the hotel sector, and sometimes the more distressed, the better the opportunity. But I'd look at on an individual deal by deal basis, because eventually this is the most distressed, we will have ever seen certain parts of this sector, and no individual it goes through this unscathed. So there will be great individual deal opportunities across the asset classes as one-offs. So, and I think that is the opportunities here. So there's obviously a lot of people that have COVID fatigue. And so that is probably the best time to come in and start looking at your strategy. And don't look out over 12 months, look out over 24 to 36 months, maybe 5 years, and you will see some life-changing opportunities.
Thanks, Rick. I guess there's the point that we try to look at the questions from the audience. We have here a question. I think this is a good topic to discuss. He's asking, what are your views on real estate tokenization? So he defined real estate tokenization refers to the division of a property into tradable shares or digital assets on a blockchain network. So many countries are doing this, but they have to have the legislative changes to create a friendly business environment. I guess his question is, what are your views on real estate tokenization? I think we can go first with Carsten.
You think I'm the expert on that? Well, we do look at the blockchain and crypto assets, of course, especially digitalization of assets. And I think there's a pro and there's also a con when it comes to this kind of topic. I mean, the pro is clearly that you can make assets available to a broader public, which you could not before, in the sense that you can really slice and dice these kinds of things, put it into smaller packages and then distribute it in order to also diversify. That's clearly a pro. It's also something which is going to make the whole thing more efficient in terms of transaction speeds, fungibility, etc. The con is that you basically translate an illiquid asset into a liquid asset. And that should ring a bell. That's what happened in the US subprime crisis as well, with these asset-backed securities, for example, which of course were not digital, but which followed the same principle that you took something which is illiquid by nature, such as real estate, and turn it into something which you can trade on a daily basis. In normal times, there is no issue with that because there's sufficient liquidity to facilitate the market making. But in crisis times, when liquidity dries up, suddenly you have an overhang of sellers, you have buyers disappearing from the market, and prices will plummet, as we've seen it in US real estate. So I'm a little bit torn. I understand the concept, I see the idea, I appreciate the advantages, but from a financial research perspective, it's always difficult if you want to make something more liquid than it actually is.
Thanks for that, Carsten. I think for this question, I'll have to throw this to Rick. With regards to Philippine property prices, there does not seem to have any decline despite the pandemic. Properties here are higher than many neighboring countries. Does this mean the bubble does not pertain to the Philippine market? Do you see property continuously increasing here?
Yeah, no, good question. Across the asset classes, if you're in Forbes Park, you haven't seen decline in property pricing, but if you've got condos in BGC, you've definitely seen prices drop and rents drop, anywhere from 20 to 30, 40%. So across the different asset classes, retail's obviously gotten hit extremely hard. And so you've definitely seen asset values drop and basically rental rates drop. So the industrial logistics sector has been strong. So I think we've seen some opportunities where anybody's, people saying, hey, listen, I've run out of cash. I'll sell my property to 40 to 50% discount. So we are seeing individualized distressed opportunities. Yeah, I mean, with the residential pre-sales, those are pretty much stopped. On the residential side. So, but you are seeing a lot of trading in the secondary market in the Philippines. So, no, definitely the Philippine market is not immune from global trends. and the market is not as liquid as other markets. So you will see more trading at reduced prices. It's definitely a tenant's market. It's definitely a buyer's market. It's definitely a market that this year will be the year for deals and trading. So people will be forced into that situation. And banks will also be looking to basically, whether it's calling loans or they're already setting up some individual, asset management companies as well. So real estate will be affected. There will be price drops, and there will be rental rate drops, and there will be cut rate opportunities.
Thanks, Drake. We do hope that we can answer all the questions given by the audience. Unfortunately, we won't be able to answer them live here, but we will be answering them via email. So we will be responding to all your questions over email, and it will go through all the panelists. That being said, I now turn you over back to Bambina.